the liquidity crunch problem, right? Because you may be cash poor, but you may have assets that are illiquid, and you may not be able to liquidate these assets very quickly to meet your immediate cash needs. So yes, if there are two broad categories, which would be people who have somewhat of a liquidity crunch. So they may be asset rich, but these assets may not be liquidated in time or easily. You can't liquidate these assets easily to meet your immediate cash needs. And then there are people who may have squirreled away some money and saved up, and they might be able to meet this. So the correlation, there might be some broad correlations, positive correlations there, but it goes back to how much of a liquidity crunch a person is facing.
What are, I guess, kind of, this is where it becomes a little bit more hypothetical. What is kind of the best way for people to use that money? So obviously, if they have to make rent payments or they have to make mortgage payments, that probably goes to the top of the list. But after that, are people better off like paying off bills or paying off medical bills, or from a stimulate the economy point of view, are they better off trying to use as much of that $1,200, going out to local restaurants and doing whatever local shopping they can do to try to keep, I guess, kind of priming the pump on that local economy?
So the intent of the stimulus checks was to get people to go out and spend. And so ideally you would want that, but if you are part of a segment of a population that needs to meet your immediate debt and expenses, then you don't want to have to pay 19% interest on your credit card bills, right? So, so in that situation, you want to make sure that taking care of, because you don't want to pay very high interest on debt. But if that has been taken care of, yeah, ideally you want to pump prime, and that was the intent of these checks, to get consumers to go out and spend. But what you do need to understand is that this situation is unique in the current COVID crisis that we are facing, COVID-19 crisis that we are facing. And that is with social distancing, and a lot of people are concerned about going out, they may not actually go to restaurants and spend that money. And so, it's likely that they would spend it on somewhat less impactful items like your groceries and maybe takeouts, but they're not going to be, they are going to be concerned about going out and spending this in restaurants. What I also want to say that compared to other stimulus packages in the past, during times of recession, people are unlikely to go out and purchase big items like electronics or putting it towards a purchase of a car. It's just that this is a very, this is a health crisis. And so that is also going to influence their consumption habits. And so you may not see the same kind of effects that you would have seen in past stimulus initiatives, with the expectation of people going out and pump priming the economy. So, so the circumstances are a little different right now.
Why is it different? Because it's a health crisis? Is it just we're worried about different things than if this was just a kind of normal economic downturn?
Yes. So this is where you see that intersection between health policy and fiscal policy. It's somewhat of a unique intersection here, because businesses are closed, restaurants and small businesses are just starting to reopen, and they are also faced with grappling with how to make the environment safe for their customers and clients coming in. So this has a lot to do with also people feeling safe going out, and wanting to make sure that when they go out to restaurants are following guidelines and ensuring that there is social distancing, ensuring that their staff, they're healthy and safe. And so this is a slightly different situation that has a direct impact on our consumption habits, what we consume, what we buy, and so that's going to definitely play a big role in this. Till things sort of we have a better grips in terms of people feeling safe, and that we see the number of cases coming down, and they are not you do not have to feel overly cautious in prior circumstances, but right now we do have to be cautious about that. So that's going to impact our consumption habits.
So we talked to a homeowner in Ohio City yesterday who said that she and her husband are really worried about the future. They're afraid there's going to be another I guess next flu season, that there will be another kind of wave of coronavirus that may shut things down. And so they're doing their best to pay their bills, but then squirrel away the rest of their stimulus check. And so they want to save it and put it in their bank account so that they can, have as much money on hand as they may need later on. That seems to kind of run counter to the whole purpose of the stimulus check, though, right?
Exactly. And this is where it is a very sort of an orthogonal issue that we are facing right now, because people are also doing what you would call precautionary savings, right? They are concerned about what's going to happen in the future. And so they're not going out and spending, and they're saying we don't know what happens if we have the next wave, or even if we don't see a recovery and the number of cases go up and you have to shut down again. And so the precautionary motive is a lot higher right now. And so this is why it is extremely important that, and it's a very unique circumstance, right? But it's very important that we focus on mitigating some of these health issues and aspects that we are facing as a result of COVID-19. When people feel confident and people feel safe, they are going to go out and they're going to spend. So if we were to focus on mitigating that problem, ensuring that we don't see the next wave of COVID-19 or the second wave, and we are taking precautions, and that everyone is actually wearing their masks and making sure that the transmission of the disease is mitigated, then the transmission of the fiscal policy would be a lot better. And so it's a very fine balancing act. But I would say that the focus on making sure, and I think Ohio has been doing a very good job in doing that, in making sure that we keep the numbers low, we flatten the curve, and we are able to keep the fatalities low, then that's going to build consumer confidence. People would say, hey, I feel safe going out, and I know that there are some strict rules in place to make sure that people are safe. And so once people feel safe, the precautionary motive will start getting less, and then the fiscal multiplier effect will be a lot greater.
Is the money doing any good sitting in our bank accounts earning, minimal interest, or is the purpose for it to come into our bank account so we can shoot it right back out again?
So it really depends. Like I said, if the money is going to go into the segment of the population that's facing less of a liquidity crunch, people can think of investing that. There has been a lot of talk about how there have been these corrections in the stock market, and even small amounts of funds channeled towards retirement or putting it into the market. There is a lot of volatility, but if you have the benefit of age, it might not be such a bad idea in looking at alternative assets to set aside, and so that money can grow.
What would be
so
those?
interest rates are very low right now, so they're not exactly very favorable for saving. So if going out and spending is not exactly what you want to do, investing might not be such a bad idea.